We are now going to turn to the discussion of our 2018 survey of community banks. It's my pleasure to introduce Mike Stevens, who's Senior Executive Vice President of the CSBS and leads the public policy, financial supervision, federal coordination, communications, industry relations, and professional development functions. He serves on the faculty of the Graduate Schools of Banking of Colorado and Texas Tech University, and he began his career as a bank examiner for the Iowa Division of Banking. Where's our Iowa folks? Yeah, he's from good stock, right? Okay, and also Andy Meyer. Andy is a senior economist here in the St. Louis Fed's Supervisory Policy and Risk Analysis Unit. He received his PhD in economics from Washington University in St. Louis, and he conducts research on community banking. He also conducts statistical analyses of the downgrade and failure risk of commercial banks and serves on a Federal Reserve Committee to improve off-site surveillance of banks. I'll turn it over to you.
Thanks, Julie.
Thank you, Julie. And before Mike launches in, I need to give the standard disclaimer that any silly opinions I might have about the survey are my own and do not reflect those of the Federal Reserve System or the Board of Governors. So forewarned.
So good afternoon. This is our fifth survey, national survey that we have done. So the sixth conference, we started this in the second year, and also includes direct engagement with the industry. The credit for this really belongs to the state commissioners that administer the survey, push for the completion of it from their banks, and also either hold town hall meetings or do the 5 questions for 5 bankers. At staff, we just facilitate this process, which means we give them all the materials, and then we just spend the next 3 months hounding them to send out the survey and call banks and do all that. So we really appreciate all their efforts, because it produces this publication. You hear me often say that it is a one-of-a-kind look at what the banking industry is thinking, what community banks are thinking, and the issues that they're facing today. But we've been thinking more about the survey and about the outreach that the commissioners do, and thinking, what does it tell us about the future? What can we glean from the future, given the important role that these institutions that we've established through this conference, that these institutions play in the local economy and how that feeds up into the national economy? What does it tell us about the future? And so I'm going to do my remarks and observations from the report kind of in that context, and then we'll talk more about that at the end of our presentation. Andy?
All right, so thank you. So in journalism, you want to make sure you don't bury the lead, so I want to start off with sort of our headline number here. For the first time since we started the survey, our estimated total compliance cost in community banks across the country is actually going down after trending upward for several years in a row. Now, the way we get this number is that we ask community bankers in the survey, what proportion of your total personnel expense do you estimate to be attributable to directly to compliance costs? What proportion of your data processing, of your legal, of accounting and auditing, and of consulting and advising? And some of you may recognize those as explicit line items in the other non-interest expense report in the call report. So once we know those estimates from each banker, we get a proportion, a mean proportion for each one of those, and then we know how much every community bank in the country spends on that. We just do a little arithmetic, and we came up with a $4.5 billion number in 2014 that rose all the way up to $5.4 billion, and it's now, for the first time, coming down. So that's the good news. Now, of course, this doesn't mean our problems are over. There were still many concerns expressed throughout the survey, and especially in the open-ended questions. So this is certainly not the end of the story, but we'll be very curious to see whether this downward trend continues or whether we'll get another uptick. So why might that be? We don't know for sure, but we think it might have to do with the fact that banks are over their big startup costs, and we're a little bit more into the steady state and a little further along the learning curve. There may be a little bit better tailoring of regulation for bank size. banks may just be in better condition and therefore not having to spend as much on compliance and retrofitting. And finally, banks are just larger on average, and we know from various previous research that larger banks have certain economies of scale. So those could be some of the reasons, but we're very curious to see whether that continues into the future. So we have a lot of new questions on here. That was one of the old ones, but we want to focus our talk today a little bit more on the new ones. Actually, this is a little bit more of an old one, but we spent a lot of time talking about small business yesterday and today. By far the biggest competitor for small business loans for community banks is other small community banks. Mid-sized community banks have about half that. Regional banks come in a distant third. And importantly for our panel discussion coming up, fintech firms have a very tiny percentage, 0.2%. But look what happens when we ask, what is your expected future primary competitor? Fintech firms jump up all the way to 6.9%. So right now, and at least in small business loans, it's not a big threat, but it's looming on the horizon in the eyes of community bankers. More on small business loans. What is your response to competition from other banks? In particular, how often did competition from other banks cause you to lower interest rates? And it turns out about 58% lower their interest rates about half of the time or more frequently. So it's something that happens quite a bit. Similarly with lowering of fees, if you look at about half the time or more, just under half, about 47%, will lower their fees, but banks will never or rarely compete by extending maturities, reducing collateral requirements, allowing more borrower leverage, or requiring fewer covenants. So the general underwriting standards are still staying in place. They tend to make most of their movements in either interest rates or fees. So we found that interesting and somewhat comforting. So turning to consumer loans, to no one's surprise, credit unions are the dominant competitor, coming in at around 41%. But small community banks come in second, so that's nice. And again, fintech comes in at only 1.6%, but when we say, what is your future? Fintech jumps all the way up to almost 15%. So again, as we'll hear more about in the coming panel, fintech is, when they're not partnering with them, they're worried about competing with them. And so we'll hear more about partnering and competing in this next segment. But again, credit unions and small community banks come in first and second.
So in this year's report, you'll notice I think a distinct difference in the language that is used about what it means to be a community bank. It strikes me that it's much more specific and that banks are really zeroing in on that clarity about what it means to be a relationship lender. And I think that this, understanding your niche, understanding how you play in your marketplace, I think only benefits a community bank to understand really what their sweet spot is. And I love Janet's comment yesterday about, wow, we're actually viewed as competition. And I thought that was a great comment, considering what the challenges around community banking have been and the pressures that they have in their marketplace. I also thought, putting another good example was putting a finer point on what it meant to be a relationship lender. And the point was made that, remember, that's about a loan officer and a business person. And we tended to focus on it, or to think about it in more broad terms about, it's about the bank and the business. No, it's about two individuals that know each other and that work together. And I think that brings a lot of clarity about what it means to be in a relationship model. And then the last point there, high touch combined with high tech. And I think where the industry is trying to figure out how are these two going to work together? How do we, our sweet spot being a relationship type of model, and how does that jive with a technology-driven economy and what consumers want. And so banks are clearly thinking about that. And so that's a nice segue into thinking about technology. And one of the other changes that I've noticed in the report over these last few years since we've started asking about technology in the survey is when we started this, it was all around this question, wrestling as whether technology was a friend or a foe for community banking. And when you read through this report, we've made the shift. It's friend. Not as much foe talk anymore. It's more about, okay, what are the tools and the resources that are out there? How do we work them into our business model? So you see, for the first time, I saw specific references to officers being appointed, and you see a couple of examples up there. Specific officer titles tied to technology. In the community bank case study competition, which we've talked a lot about, I even read one example where the bank had appointed a technology integration committee. And that group, they were responsible for evaluating all sorts of technology tools and platforms to decide what worked with their business model. So this technology and all this innovation is leading to really fundamental change to how banks are structured and how they operate. We have asked, and since the beginning of the survey, there's a long list of products and services that banks would typically offer, your typical bank would offer. And we always ask about, are you going to expand in this area, contract in this area, or do you offer this service and you're going to continue? So a variety of questions like that. And I think to drive this point home, when you look through those list of products and services, the places where banks are adding, all technology related. Those are the products and services that they are looking to add to their business. So Andy will go through some of those survey questions.
Yes, so as he mentioned, we have a whole lot of them. We're only going to cover a few of the highlights here. But regarding online loan applications, that's a technology that's been out there for a while. And we have roughly equal percentages, about 38% currently offer and don't offer with no plans to offer. So it's not a dominant thing just yet, but we expect the offer category to increase because we've got 23% up there in the upper left who don't offer it but plan to offer it in the next 12 months. The good news is absolutely no one who offers it regrets it because we have 0.0% who don't offer but who offer but don't but plan to get out of it. So that's good news. Here's a much newer technology, interactive teller machines. This is kind of a kiosk where you can take out a mortgage. It's much more than an ATM. This is an ITM that allows a lot more. Now, this is not caught on with very many community banks. 74% do not offer, but we have 8.2% who do. And we expect that to grow because of the 17% who plan to offer it soon. More regarding technology, we've got 2/3 of bankers who think that the adoption of new or emerging technologies to meet customer demand is either important or very important. So that goes to Mike's point that that train has left the station. That's definitely something at the forefront of most community bankers' minds. That number jumps to almost 90% when you add in moderately important. So definitely something to keep track of. This is by far our biggest category. We have 66% who think cybersecurity is very important. That jumps up to 95% when you add in important. One of the bankers in one of the videos, I believe in one of the case study videos, said 10 years ago, that cybersecurity was something you added on at the very end, and today you bake it in from the very beginning of your development process.
So a few words of wisdom that we were able to extract from the commentary. And it really just gets down to that, look, the opportunities in this space are great, and the opportunities for a mistake are also great. And so you don't want to adopt the wrong technology, or you don't want to adopt the technology for the wrong reason, is kind of how I would sum these up. And I just loved the quote of bad tech is worse than no tech. So while I think that overall in the report there's a lot of reason for optimism and a more positive environment for community banking than what we've seen in a while, there are challenges that remain. Specifically around human capital, and we've talked a lot about this over the years. I think that those institutions that are caught up in a demographic shift, away from rural communities, they're going to have to adjust, and that's going to be a tough one to go up against the demographics. And then when it comes to bringing new bankers into the system, we've seen a lot of student engagement over the years through the case study competition, and you're seeing just a lot more colleges and universities developing programming around community banking. Or banking in general, partnering up with the association, working with the industry. And it hit me that every year we're hearing about more and more of these. I talked to Maggie Abney, our faculty advisor for our case study team, last night, and she said that there's a cohort of 20 universities that have formed a peer group that either have or are developing banking programs. And they're working together to figure out, to determine curriculum and content and the direction of those programs. And then she says there's about another 10 that aren't part of that group that they're also engaging. And I think that's a real positive movement for the industry. And then after hearing Louis Nguyen's paper today, it seems to me that these universities are onto something, because if you're going to grow your own bankers, apparently that's a good long-term strategy for loan growth. So that was a lot funnier in my head.
Yeah.
But,
all right, but speaking of human capital challenges, how important were succession issues in community bankers' decisions to seriously consider accepting an acquisition offer? Mike wanted to get rid of this slide because Mike Milshanowski stepped on our presentation here, but he said, as he noted, fully 45% think it's important or very important, and really only 31% think it's not important or only slightly important. So this is something that's at the forefront of community bankers, as we know, in rural areas and urban areas alike, so something that is definitely at the forefront. We want to move on to a couple of new questions then on regulation and taxes. An item that a lot of community bankers in particular are struggling with is the current expected credit loss model, CECL. This new methodology requires you, well, I don't have to tell anyone in this room, that you need to start providing for loan losses at the time that you make the loan, which is somewhat jarring to bankers because nobody makes a bad loan. They only go bad later. Why would I want to write something? If it were a bad loan, I wouldn't be making it in the first place. But it's here. It's not going anywhere. Fortunately, over half of the respondents are actually right there in the middle of the process. 8.3% have not started, but I hope they do soon, because by 2022, this will then apply finally to everybody in all the banks. So as I said, this is the first time we've asked this question, but we plan to ask it again, and we hope to see the weight move further and further down. We also asked about tax cuts, the basic Tax Cuts and Jobs Act. What kind of impact has it had on several different products and services? We're going to focus right now just on small business loan demand. Actually, well over half say that through 2017, or so far in 2018, it hasn't had any effect at all. But in the future, they expect that to increase. Now we've got, going forward, how do we expect the Tax Act to affect small business loan demand? We're jumping up to increase is now up to 64.8%. Similarly, with mortgage demand, so far in 2018, not much of an effect. 80% say no effect. But going forward, we're jumping up all the way to, well, we're reducing that no effect down to 58%, and increase is going up to 35%. So basically, the optimism is there at present. So far, the tax cuts don't have a big perceived impact, but they have an expected future impact, which is a segue into an exciting new study that has been sponsored by CSBS that Mike is going to describe right now.
So in the 5 years that we've been doing this survey, we've been talking at CSBS about how we can better use the data and how we can use it to tell a story about community banking. So over the last few months, Jim Cooper and I have been working with Bill Dunkelberg and Jonathan Scott from Temple University to see if some of the questions in the national survey say something about how bankers feel about the future. I should just note I'm really happy that Bill and John have been able to join us today. And I understand from our standpoint, it was like we found the needle in the haystack, and then I found out that like I was the only person who didn't know who they were. But they've been great to work with and really provided great thinking in this and have helped a great deal. So today we are excited to release their white paper, Indicators of Community Bank Sentiment, that uses the survey data and provides, this is the overall conclusion about how banks break out in terms of a positive or negative sentiment towards the future. So it's a short paper, but it does a further breakdown into age of the CEO and geographic location, size, compliance costs, just a lot of really interesting insights into how different types of banks might look at the future. And so we are going to work with Duncan and John over the next few months to develop this into an official index of community bank sentiment that we can regularly update and provide some insights into how bankers are thinking about the future. And we think that that's really provides an important insight into the future of economic growth at the local community level and nationally. So the paper has been out there at the desk. I hope you've picked it up. We are issuing it publicly through a press release this afternoon. So a lot of places to get it. And I would encourage you that at the end of the paper where it talks about our plan for development in the future, it does invite comments. And so there's a place for you to email and provide any observations that you have from the academic perspective, from the industry perspective, whoever has a thought or an idea about how we could approach this. But we're very excited about this project and really appreciate the support we've received from Bill and John.
So with that, we have a few minutes left. If anyone has any questions directly about the survey, we'd be happy to answer them. And then if you have more general questions regarding the panel discussion, you'll have opportunities then too. Does anyone have any questions or comments? If not, maybe we'll just jump right into the panel. Thank you very much for your attention.